How's it going, everybody? Unfortunately for all of you, I'm going to be moderating the next couple of presentations for the companies. We're going to start here with Cartier Resources. It's a $45 million market cap company. It's trading at ECR over in on the Ventures Exchange in Toronto, and 6CA over here in Frankfurt. As you're going to see, they own a vast portfolio of gold assets on the Greenstone Belt in Quebec, and they focus on relatively advanced gold projects in which they hope to increase their resources soon. And with us today is Philippe Cloutier, who is the president, CEO, and a board member of Cartier. Philippe, take it away.
Me very well? Yeah, thank you. I'll skip the first few slides in benefit of time. One of our highlights is that once we acquired our flagship property in 2013, it attracted the sponsorship and participation of Agnico Eagle. And so they invested and took 19% of our stock. That attracted money, and we've never looked back. And recently, we acquired another significant shareholder because we acquired their ground to expand on the Chimo Mine property, and therefore we now have O3 Mining as a significant shareholder. We have a very small team, but don't let that fool you. We have 29 contractors out in the field as we speak because we've got 2 machines rolling 24/7. So myself, the president, founder, and a director of the company, Gaétan Lavalière, a gentleman I graduated with over 35 years ago, and Roland Deshoff, our senior geo. I like this slide a lot because it basically walks you through what geologists are up against. At the far left of the slide, that's what most juniors do. And statistically, you have to, bang on a lot of rocks. You have to look at 1,000 projects before one of them becomes a mine. So the odds are stacked against you. In 2012, we had cash in the bank. The markets were really bad, so we went on a shopping spree and we bought 4 deposits. Very advanced exploration plays. We got very lucky when we bought the Chimo Mine, past producing gold mine, from a bankruptcy sale. And that's when Agnico Eagle got involved. That's when we attracted a lot of money. And in the last 5 years, notice the performance. We started drilling. We produced a first, a second, a third resource estimate. Then when we saw or we felt that the project was economically viable, then we allowed ourselves to expand and we purchased the surrounding East Cadillac project. And that's when O3 Mining became a shareholder. And then after that, we produced a 4th resource estimate, and we just a few weeks ago delivered our PEA. So you're looking at a rate of resource increase of about $8.50 an ounce. And that's only because this is a past producing mine. It has a humongous amount of diamond drill hole information. And we decided to take our time and compile this and design exploration programs that had a lot of performance to them. Just so that you know where we explore, we are in Quebec, the province of Quebec, Canada, in the Abitibi Greenstone Belt. You can see 2 groups of properties. One, a group of 3 properties with deposits on them that are in the emerging Windfall mining district. And you might have seen this week a Cisco and Gold Fields partner to get this project up and going. It's not that we don't appreciate these projects. They have tremendous value. But as you will see, Chimo is our flagship. That's what we're focused on. And again, we released a PEA just 2 weeks ago. So that's where we work. For the rest of the presentation, I'm really going to focus in the Chimo Mine Project area, and that's because it's along the Cadillac Fault, and you can see all the mill infrastructure and the workforce that surrounds the project. So there you have it. In dark green, that was our original Chimo Mine Project. Past producing mine. Small property. A lot of people ask me then, Phil, why didn't you buy that extension in 2013 and get much more work done? Well, it made no sense purchasing that extension until we discovered that, that project around the shaft area was economically viable. by 2021, in November of 2021, at the Dutch Goldmesse here, myself and the president of O3 Mining, Jose Vizquera, if you had been there, you would have seen us chatting on the corner of a table, and we were negotiating of the consolidation of both our land packages. So when it was time to pay to acquire that ground, O3 said, no, we'll take shares. We believe this is going to track up, and we want to be a major shareholder of this outfit. And so, as you can see also, immediately outside that dark green property, there is about a 15-kilometer stretch where there's known mineralization and other deposits. But they are always being on the shelf because people would refrain from exploring those because only the Chimo Mine Project had the shaft down to 9,900 meters and underground workings. Also, as you can see, well, we're right off the highway within 35-minute drive of Val-d'Or, qualified workforce and mining service providers. I like to show this slide because although it's been a year old, there's 25 million tons of mineralized material, some of it indicated category, some inferred, with an average grade of 3. Why is that important? Well, it just so happens that the mineralization at the Chimo Mine Project has a very good mineralogical contrast and is amenable to ore sorting. So that average grade with ore sorting goes up to 5 grams per ton. And what that does is it reduces the tonnage that you're going to have to handle. It reduces the milling costs, the transportation costs. It lowers the environmental footprint, and ultimately what you're going to put on the tailings impoundment site. And in our case, since it works, it allows us to build a much smaller mill. There are other deficiencies to it, but the main advantage to it is we're able to take the grade here, which is perceived as low, although it's about 3 times what is being mined locally, and it could go up to 5 grams per ton. So that's the specifics of our recent PEA that we published 2 weeks ago. You can see on this part of the right slide all the mine workings that they've planned out. Almost 50% of the mineralization or the ore that we're going to be extracting is in and around the previous mine workings. Then off to the further off to the east, there's the East Chimo Mine discovery, and then the Nord-West property that we acquired through the consolidation of East Cadillac. So all in all, you're looking at about 60% of the ounces that were delineated in the resource estimate. For reasons that I can mention after, there's 40% of those ounces that are back pocket. And so we use a long-term gold price of $1,750 US gold, exchange rate of 1 to 0.77. If we did not do ore sorting, and we will be mining 4,500 tons per day at a grade of 2.7 for a total production of 1.4 million ounces. But the ore sorting, as you can see, drops the amount of tonnage that you can mill. So it brings down the size of the mill that you have to build. At $30 million per 1,000 tons per day, that's a significant cost economy on the building of the mill. Your grade goes up, but you do lose some ounces through that sorting process. So it's not to say that sometime after they've started production that they go full mining and then they stop ore sorting and then they just mill that to recuperate all those ounces. So you can see the differential between the US gold price and the all-in sustaining cost. That's about $1,000. So you're producing 117,000 ounces of gold per year with $1,000 benefit. So it's $117 million free cash flow per year for a minimum mine life of 10 years. And I've added a sensitivity to the gold price slide. So the base case we're using is $1,750 per ounce. If you could see, if we were doing it at today's gold price of $2,000 per ounce, well, our NPV is almost $500 million, and our internal rate of return is almost 26. And even if the price of gold dropped $150, we're still making money. So we're quite happy with what we've accomplished here. A bit of geology, because I'm a geologist. This is a map, regional map, and as you can see, that black arrow, that's where we are exploring right now. I've left in the property boundary in a dark black line just to show you the effects of having a property boundary. You can see where there's a sharp interruption of historical drilling. By having acquired 100% of that property, we no longer have that encumbrance, and we're able to drill, 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 and you will see the effects of that. If you look further to the west, further to the east, there are drill-indicated showings and deposits that we, for now, have shelved, but we're hoping to get to in the next years. So the next slide is basically a vertical slice. You're going to be looking north through the system that we're drilling. And there you have it. That's a long section of new gold results that we published yesterday morning in a press release in the bright yellow boxes. What you can see on this slide is, again, a vertical slice of the Chimo Mine Gold System. You can see the shaft going down to 920 meters. You can see the underground development that's already there, and where the mineralization exists. What I'd like you to see on this slide is, well, you could guess where the property boundaries were and why the 5BW and the 6N1 zones, the new zones, are very important, because prior to this moment, we could not drill that area. And by intersecting gold, we're seeing that this can grow the resource significantly for us. And there's no reason why there's not a mirror image on either side of the shaft. And so we're very excited. We know this is going to lead to a fifth resource estimate and an updated PEA. So stand by for news. We have a machine that is currently drilling in the 6N1W area, and a machine that's out in the west Val-d'Or area in the shallow parts. So before I wrap up, the takeaway is every time we have thrown an exploration program at this project, it has continued to grow the value and the ounce count. The PEA that we delivered is a PEA that is standalone, is as if we would build it ourselves, so as not to be taken hostage by any of the mills along the highway. However, if we did elect to not build a mill and not have ore sorting on site, then we would be saving approximately $150 million on the CapEx, which would obviously make this project even better. I think by trying to build something standalone, you offer a lot more optionality going forward. So what are the next catalysts? We continue to drill with 2 machines, so expect drill results. We're going to continue refining the engineering and to make better the numbers underground. And ultimately, we're going to upgrade the resource estimate and the PEA. And just to leave you on an exciting note, I get this often. People usually say, oh, Phil, grade is king. Yeah, but cost is queen. And when you bulk mine underground, which is the way to go these days, well, you're able to recuperate a lot more ounces. There's 25 years of mining and metallurgical technologies that we could apply now that was not present when they shut this mine in 1997, which, by the way, the price of gold was $275 US. So it's a much different economic environment. It's a much different technological environment. And the picture of that is that's a picture of some of the ore underground at Chimo, really high-grade stuff. We chose throughout the past 5 years not to headline that in our press releases, not to give the wrong example, but that's 25% of the ore that can be found underground at Chimo. So it's kind of fun, the mine managers can plan on having a jewel box before they hand it over to the mill. So that's my presentation with a minute and a half left. If you have any questions, fine. If you don't, I will be in booth number 4. What I did not want to risk it here, the next speaker is a lot younger and adventurous than I am, and she will be trying new technology. I don't want to risk that when I do a presentation. Thank you.
Anybody has any questions? I guess I could ask you a question.
Sure.
Where do you think you're going to be getting the money for the CapEx from?
Well, first of all, we need to get this to a feasibility level to continue to de-risk it. Obviously, with such a low capex on our part, with our market cap, it's attainable to want to build it ourselves. We have 2 mining partners, and we've seen local capital investment funds actually show up in the Abitibi. And the new thing seems to be they pick and choose projects that are at the PA level. They like to bridge you from PA to feasibility, and then either continue building it or vend it to a senior mining company. So there are a lot of solutions to finding capital for the next phases, but obviously we have a nice problem. We have a project that is economically viable, standalone, and we need to continue developing this thing.
Good stuff. Good luck.
Thank you.